So today we're going to talk about an arbitrage opportunity in AMC Theaters. Hi everyone, I'm Cody Koch. Welcome to the channel where I talk about trading, investing, and business concepts. So I first heard about this opportunity by Jim Chanos. Chanos is a very well-known investment manager. Actually, he's well-known for his short selling strategies. And he mentioned this recently on some news stations, and it ended up popping up on several stations and online and on a few magazines. So I did some research into it. I actually liked the opportunity, so I decided I would present it here on my channel. I'm going to go into some details about this also, because it's not 100% perfect. There are a few caveats to it that I want to mention that haven't been mentioned anywhere else, and so I think it would be instructive to discuss this. Now, before I go into this opportunity, as always, use intelligent exits and position sizing, which are really, to be honest, the secret to being successful in investing and trading. Exits and position sizing, always focus on them, always important. So in August of 2022, AMC Theaters issued a new class of shares, a preferred stock issuance. Now, normally preferred stock is very different than common stock, but in this case, AMC Theaters have deliberately made the two securities to be exactly the same, for reasons I'll talk about in just a second. The ticker symbol for the preferred shares of AMC is APE. The ticker symbol for the common shares of AMC is, of course, AMC. Now again, for all intents and purposes, these two securities are exactly the same. As you can see here in the executive summary, as you read through this, you're going to find that they both have the exact same voting rights, they both have access, and they both represent the same amount of ownership for those assets and the cash flow of the business. So in every way, shape, or form, these two are exactly the same. Okay, everybody, so to kind of explain this preferred share issuance of AMC, I'm going to go into a little bit of history. So AMC went in prior to the COVID blow up. AMC was doing decent. It did well. But during COVID, it got hit very heavily. Obviously, nobody was allowed to go to the theaters. It raked up a huge debt load. Its debt load more than doubled during that period between before and after COVID. It's got a massive interest expense now. Also, it appears something fundamental has changed. A lot of movie producers, movie production companies are actually starting to stream their movies launches rather than actually launch them in theaters as they traditionally have. So something fundamental appears to have changed in the industry. I read something that if AMC actually reached the numbers it had prior to COVID, due to all the debt that's been on its books and cost and so forth increases, AMC would actually be losing $200 million a year, and back then they were making $600 million a year. So the fundamentals of AMC have changed quite dramatically. Now, that all said, because of this large debt load, AMC reached out to its shareholders and said, hey, can we issue more shares? The shareholders voted this down. They said no. Well, that's unfortunate because AMC needs this. So they worked out, the board of directors, the CEO, everybody in the company worked out a workaround. They had the ability to launch up to 5 billion preferred shares. And so to kind of start this process off, and they did this without requiring shareholder votes. So they've kind of figured out a bit of a workaround on this. Because they can issue up to 5 billion preferred shares, they decided to start this ball rolling, so to speak. And so for all intents and purposes, for every one share a common shareholder held of AMC stock, they were issued essentially one APE stock, or a preferred share. They were issued this as a type of dividend. Okay, and so as of this recording, there's around 500 million preferred shares outstanding, as well as the exact same number of AMC common stock shares outstanding. So you have 1 for 1 between the two. So the reason they're going to launch these preferred shares in the future is to allow them to manage this large debt load, to bring in more capital into the company to handle this large debt load. Okay, so let me go into how we can profit from this situation. So here's AMC's common stock. This is the price of its common stock, and you see its chart, and it goes back many, many years. I think it was a few years ago, it was at 21, got up to approximately $45 a share. So it's had quite a ride. I mean, from $1.47 back in January of 21, up to 45, 46, all the way back down to 70. Just very unique chart. Let's bring up the preferred shares. Okay, so here's the price of AMC Theaters preferred shares. It was issued on August 22nd, 2022, and you can see over here it's selling for $2.74. Now let me do a quick spread chart between the two of them. Now you combine the two stocks, you do 1 share of APE for every 1 share of AMC, and your financial situation will look like this chart. Essentially, it would be at an equivalent of 0.36, declined down from, I guess the day it came out, it whipped all over the place, but it got to a high of around 77 cents when things calmed down, 0.77. So that means APE was at 0.77, the value of AMC on that day, and since then it's declined quite dramatically. Now, as I said, these two securities are exactly the same. So for all intents and purposes, they should be selling up here, okay? So the way you set this up, and you can see it with this spread here, for every 1 share of APE you buy, you simultaneously short sell 1 share of AMC, and that will create this unique situation. As the two converge and come back to parity, you should be able to profit. Now, how much could you profit? Well, as of this recording, let me show you that. So AMC's price is $7.83. APE's price is $2.74. So if you short sold $7.83 per share and bought the other one at $2.74 per share, in theory, you can make $5.09 eventually, okay? So this is a very interesting situation. The return on that is quite high. So if AMC actually goes to 0, which is very possible because of its large debt load, you will make $5.09 per share. If AMC rises quite significantly, at least it should in this case, APE should rise along with AMC's common stock, and the two should eventually converge. And as of this recording, you could make, in theory, $5.09 that you would have locked in if you made this trade today. Okay, the reason I suspect APE is down so much relative to AMC is because it was issued as a dividend to AMC shareholders. I believe a lot of AMC shareholders are simply selling it off and using it as a dividend, taking the money and running. Now, there are some notable factors I want to point out in this particular opportunity. Depending on your brokerage firm, you may or may not be able to find shares to short. Not all brokers are good about having shares available for you to short. Some brokers are very good at it, others are not so good at it. It just depends on the brokerage you're using. If you have the opportunity, if you do have a broker that does have some of these shares to short, you might be able to short sell AMC and get this trade to work. Now, another thing is if you are able to find shares to short in AMC, take note of the cost to borrow them. It may be prohibitive. It's possible the interest rate could be so high on short selling the AMC stock that it's not worth your time. I also want to point out one important factor. AMC shares have a rather large short interest. Because so many people are predicting AMC is going to go to 0, that large short interest is a risk. And the reason it's a risk is because it has a potential of creating a short squeeze. For example, we have GameStop a few years ago where its stock skyrocketed massively from pennies. It devastated a lot of hedge funds and short sellers that were heavy into that marketplace. Now, you can create an environment where so many shares are short that it's very, very difficult to find shares to buy enough, and that price just rises and rises. So be very careful. If you are able to find some shares to short of AMC, be very careful with this just in case it gets in a short squeeze position. Get out of that position as fast as you can, buy back your shares, and just head on down the road. Now, in the long run, it does look like AMC is in a bit of financial difficulties. They've got a lot of debt. They're not making as much money. The streaming industry has changed the theater industry quite a bit. So we really don't know what's going to happen. As things stands today, it looks like the debt holders are going to end up owning AMC, and equity holders, as current equity holders, will be wiped out, and those debt holders will take over. They'll probably restructure the business, and then they will reissue shares in the hands of those debt holders at some point in the future. That's currently appears to be what's likely to happen with AMC in the long run, unfortunately. I've gone to many AMC theaters myself over the years. I really enjoyed them. This is kind of a sad passage of history, but this unfortunately is the nature of things. Things do ebb and flow and change a little bit. I do want to point out just one last thing. It is possible for APE and AMC to flip and go the other way. It's possible that APE may become much higher priced than AMC, in which case you may flip this short selling buying kind of spread / arbitrage trade that I've just been discussing. You may turn this over and go the other way. But in general, as it stands today, APE is the one you want to buy and AMC is the one you want to short sell. Okay, so I wanted to point out one other thing in this case. Since there's an issue with possible you may not be able to find shares to short, or the interest rate on the borrowed shares may be too high, or the risk of short squeezing, you could use options. Now, I'm not going to go in a lot of detail on this because you kind of have to really know your stuff when it comes to options. Be very careful with it. But if you are going to short sell, let's say AMC Theater and buy APE, what you might consider doing are buying put options, preferably a put option that is above 80 delta if possible. You may not be able to find that. It looks like the implied volatility on the options are quite high right now, and I have a suspicion the reason that is because of the simple fact that so many people are trying to play the AMC APE arbitrage situation. They're using options as one way to do that. So since the implied volatility is so high, one possibility is, of course, you could actually short sell, use some kind of vertical spread to protect yourself in some combination of AMC and APE. Now, I'm not going to go into that in this video. That's way too sophisticated for this video, other than to just point out that there is a possibility there. If you know options, you could take advantage of it. You could buy put options options if they're above an 80 delta. You could short some of these options, use vertical spreads, some combination of APE and AMC, some mix of the two. We're starting to get some pretty sophisticated stuff, so I really don't want to go much further into that other than to just say that there are possibilities with options that will get around the issues you have with getting the shares borrowed and so forth. So in summary, here's the opportunity. You can buy 1 share of APE for every 1 share of AMC you short sell. You'll lock in at a bit of a profit. As of this recording, is around $5. Hang on to that thing in the future. Manage it very carefully with exits and position sizing just in case things go badly. And if that's possible to work, go for it. This is an interesting opportunity that you don't get to see every day. Okay, everybody, that's it for me today. If this video was helpful or interesting, please like and subscribe, leave a comment, and thank you for watching.